Well, good morning, and I want to welcome everyone to another series in our Tax 101 series, if you will, with Andersen. My name is Steven Flynn. I'm a managing director in our Vancouver, BC, Canada office, and I'm joined today by one of my colleagues from the US. Petra Loer is a managing director in San Francisco. Petra, good morning.
Good morning. Happy to be here.
Great to have Petra here. We've got a unique topic we're going to address today. We're going to talk about a combination of income tax and valuation concepts that affect Canadian entrepreneurs who are moving to the United States, something we're seeing a lot more frequently. Petra, I don't know if you've seen some of this activity in the last little while.
Oh, for sure. Yeah, we're seeing it all the time.
Absolutely, absolutely. And so, next slide, please. We'll talk a little bit about some of these things. We've got some housekeeping we want to talk to before we kind of get to this. We've got some polling questions. We are actually accredited by the National Association. Let me get that right here. We're accredited by National Association of the State Boards of Accountancy, and as a accredited NASBA participant, we're able to offer continuing professional education credits for today's webinar. In order to qualify, you need to answer the three polling questions where they're going to appear during the session. They'll pop up at various times throughout the webinar, so please make sure you stay tuned and respond promptly to each one. You'll be allotted a minute before that question will close, and then we'll discuss and share the answers with you. If you have questions as we go through this webinar today, there's a chat box at the bottom. We'll be monitoring it. We'll try and answer as many questions as we can in this 50 minutes plus packed agenda. At the end of this, we'll have a survey, and these surveys are really important for us to understand how we did, to think about what topics you might see in future webinars. We've been doing these for a number of years, and a lot of your ideas feed this in the future. And to the extent that you'd like a live transcript of the webinar today, there's a closed captioning button. You can click on that, and there should be a fairly accurate transcription that you can follow along. So, having said all that, let's go into our agenda. Next slide, please. We will talk today about some income tax issues that Canadians face when they leave Canada. And we'll focus specifically on the Canadian departure tax rules that might face entrepreneurs that are in the technology space, the AI space, something that we see is growing. Petra's going to help us along here. Petra is someone I've worked with for a long time here, and is a partner in our San Francisco office, and she's a valuation expert. She is works with valuing closely held businesses, intangible assets, intellectual property, and has done national training for Andersen, contributes to our publications. She and I have worked together on a number of clients together, and so she'll talk a bit about some of the principles for startup corporations. I'll then talk back about some of the strategies you can use to reduce or defer departure tax in Canada, how to manage that when you move to the US. And then Petra's going to finish talking a bit about some of these US rules when it comes to 409A valuations, some of the reports and some of the adjustments. So that's our agenda today. Next slide, please. So one of the things that Canadian entrepreneurs face, and this would be Canadian residents, when they leave Canada has a concept of income taxation based on domicile or residency. We don't tax citizenship like the United States does. And so when people leave Canada, that's Canada's last chance to tax individuals on their worldwide income and worldwide assets. And so as a result, when you cease to be a resident of Canada, Canada's got a rule that says you're deemed to have disposed of certain assets for their fair market value on the day that you cease Canadian residency. And so even though you didn't sell anything, it's a deeming provision that basically says if you're not going to be resident here, we want one last chance to tax whatever unrealized gains you might have in certain assets. Anything after you leave Canada wouldn't be taxed in Canada unless it's connected to real estate or pension plans or things. We'll talk about that. But for a lot of assets, this is the last chance. And so these deemed disposition rules do not apply to everyone's assets. There are some exclusions, and some of the more common exclusions include pension plans, so a registered retirement savings plan, a registered pension plan, anything that's set up in Canada, that would be excluded from tax. It's not like you don't get taxed at all. When you go to withdraw funds later from the pension plan, those funds would be taxed in Canada, and there's a withholding tax mechanism to do that. Direct interests in Canadian real estate are not subject to departure tax. Again, there's other ways that Canada will tax the sale of those gains or tax the income for the rental of those gains. They'll put the onus on the buyer or on the tenant to make sure that happens. So those are not subject to Canadian departure tax. Stock options, again, same thing, are not subject to deemed disposition. Again, you don't escape taxation on that. When you go to exercise and or sell those shares, depending on what type of company you're invested in, that's when you'd have Canadian tax, not on departure, but when you go to exercise those shares. There are other exceptions as well, but those are some of the more common ones that technology entrepreneurs would see when they leave Canada. Next slide. So what does departure tax apply to? Well, very commonly for technology entrepreneurs, it'll apply to the common stock, to the preferred stock, to the shares you own in either a US corporation or a Canadian corporation. It can also apply to non-Canadian real estate, pardon me. So if you had an interest in a US real property interest or something overseas that isn't Canada, that would be subject to departure tax as well. You're also subject to departure tax on any unrealized gains you have in non-registered accounts. So we talked before that pension plans would be exempt from departure tax. Investments in non-registered accounts, if there's unrealized gains, those would be subject to Canadian income tax as if on the date that they leave Canada. So now you've got this deemed disposition, you've got this tax on this unrealized gain. So what are the tax rates? Well, it really depends on a few factors. It depends on what your level of income is. Canada is a marginal tax system, and so the rates can be as low as 10% of the gain. They can get as high as 32%, and that rate may surprise people because in Canada, only 50% of any capital gain is subject to income tax. The top marginal tax rate in provinces like British Columbia and Ontario is 53.5%. So if you just did the simple math and said, well, 53.5% is the top marginal rate times a 50% inclusion rate, your tax should be 26.75% in those two provinces. The reason we show 32% is that in 2024, Canada changed its rules with respect to alternative minimum tax. And that's a separate level of taxation that will impact what are called tax preferential items. Capital gains are considered a tax preferential item. And so when you go to the alternative minimum tax regime, instead of it only being included as 50% taxable, and there was changes before 2024 that it was 80%, now for purposes of alternative minimum tax, 100% of the gain is subject to this alternative level. So now you have this 26.75% regular tax, but if your gain's high enough, and I'd say high enough is probably if it's a couple $100,000 or more, then that 4 to 6% additional alternative minimum tax, depending on the province you're leaving, that'll apply as well. So we include those just to make sure people understand that this is about the rate of tax when you leave Canada. The due date of the tax, it's not due when you leave. There's no one at the border that's going to ask you the questions and collect the tax like you were back in back in England trying to leave the county or something like that. We have a self-reporting system when it comes to income tax returns. So in the year following, when you go to file your tax return in Canada for the year you left, typically on April 30th of the following year is when an income tax would be due. That's when your tax would be due. So people can leave in the year. They've maybe got a year a little bit to kind of think about and consider strategies and implications and how we might handle this. But that tax would be due April 30th of the following year. We'll talk about some strategies when it comes to how you handle departure tax and whether it's deferring, eliminating, coordinating with the US. We'll talk about that a little bit later in our presentation. Next slide, please. I think we've got our very first polling question. So that first polling question, I'll read it to you. I list three different assets here, and the question is, would the following assets be subject to Canadian departure tax? And so it's a multiple choice question, and we'll give people a little bit of time here. Uh, Petra, I talked a little bit about your history in San Francisco and where you've been. You've also got some Canadian roots.
I
Tell us more.
do. I do. So I was born in Montreal, in Pointe Claire. I'm actually a tri-citizen. So I am a Finnish citizen. My family's from Finland, Canadian, and US citizen. So the US was the last one I got. It was February, I think, 26, 2020. So right before the pandemic. So my swearing in ceremony could have been a super spreader event, but did not end up being so. Yeah, but I have two sisters still in Canada, two of my three. So I'm actually going up there next week for spring break.
Oh, fantastic, fantastic. And so it's great to hear. Petra and I have kind of worked together on a lot of different things. And so I think Petra's got a unique skill set in that she's probably gone through this concept with departure tax, although it may have been some time ago. So the answer to the polling question is all of the above. So any one of these three things, which are things we often see for technology entrepreneurs that they'll have interest in, all three of these would be subject to Canadian departure tax. And so further, when we go to talk about this, we will talk a bit about some of the strategies on how to handle this. So Petra, I'm going to turn it over to you to talk a bit more about some of the valuation concepts.
Okay, terrific. So nice to speak to everybody today. I want to step back a little bit and kind of help people understand, next slide, thanks. Help people understand a little bit about the process I go through kind of when I'm onboarding a new client, trying to figure out how to value these companies. As we know, for public stock, like if you own IBM stock or something like that, there's a ready market for that asset, right? So it's easy to see what the price is. But for purposes of the deemed disposition or for any other purpose where you would need to identify value for a private company, it's a lot harder, right? There's no ready market for that asset. So the valuation method really depends on what stage the startup is in. And so when I first talk to a startup founder, I ask a lot of questions about the startup. So for example, when were you founded? How long ago? Are you generating revenue already? Sometimes the answer is yes. We've gotten some kind of test revenue from pilots, but not, excuse me, any sustainable revenue yet. Or no, yes, or we are a later stage company at this point. We've been generating revenue for a long time. We have a stable customer base. Sometimes these companies are in the ideation phase where really there's just a business plan or there's been a couple of engineers working on R&D efforts. And so kind of where you are on that spectrum from the very earliest stages of ideation to, pre-IPO companies who are well funded, that really matters for what type of valuation method we're going to use. And, valuation only really has three basic methods to value any company. There's the income approach, the market approach, and the cost approach. So the income approach is the one that's kind of my favorite, if we can use it, for a stable, closely held family business. Think about a company that's a distributor or a restaurant or something like that. You may be able to use something called a income capitalization, where you're basically saying, next year's income is pretty stable. We're growing at a stable growth rate. Our profit's pretty stable. And so you can value the business kind of looking at the next year of cash flow and doing some math there. More commonly, though, for startups, there's a high growth trajectory. There's a lot of losses early on in the history of the company. And so you're using something called a discounted cash flow method. So essentially projecting out, what are the future expected cash flows of this business going forward? At some point, it's going to stabilize well into the future. And so that's kind of my favorite method if we can use it. A market approach is a common method as well. So we'd be looking at comparable businesses, either publicly traded companies in a similar space or transactions that have happened where companies that are similar to your company have gotten acquired. And we're looking at the multiples. So the acquisition price divided by some metric, so revenue or profit or something like that. We use that method when we can. And then there's the third approach, which is a cost approach. So a cost approach is usually the least preferred method. It's very common for what we call holding companies. So if you have a private equity fund or you have an entity that holds real estate, you can essentially value that company by adding up the sum of all the assets that it currently holds, right? For a startup, that's traditionally not the best method. But when we have the very earliest stages of a company where literally there's no revenue, the company has no ability to project revenue yet. Maybe they're a few years out from even, generating that first dollar of income. Then we may just default to valuing the company, looking at what has actually been done in the company so far. So an investor might come in and say, okay, we will reimburse you for the efforts that you've already put in. So the man hours, the person hours of R&D efforts that you've put in, for example, maybe applying some sort of rate of return to that. So valuation is really subjective, which is why I love it. I call it storytelling through numbers. So it's extremely subjective, and it really depends on a lot of different factors. Startups are interesting because their capital structure tends to be a little bit different than if we're talking about a typical closely held business, right? Like a distributor, a manufacturer, restaurant, grocery store, et cetera. You have common stock, which is a typical form of stock in any company. But you also have something called preferred stock often. And for an investor coming in, they often want some sort of preference. They want some sort of special benefits above the founders who put money into the company from day one. So investors can often negotiate. They get very creative in the way that they put money into companies. The most typical methods are safe notes, which we'll talk about, convertible notes, or preferred financings. So a preferred financing is, I want to invest in your company. I will give you $1 a share. I want 20% of your company. But if the company goes south, so if something happens and the company doesn't do that well, I want to get my money back. So as long as the company is doing well, I want to participate as an equity holder. But if the company is not doing well, I want to be essentially a debt holder, or I want to be near the top of the priority stack in getting my money back. Now, preferred shareholders are not debt holders, so they don't have first priority in a liquidation event, but they do have priority above common shareholders. So there's like that extra little bit of protection. Convertible notes were common maybe 5 or 10 years ago. I'm not seeing them quite as often anymore. But they're a hybrid form. So what they are essentially, they're debt. So there's often an interest rate assigned. Somebody can say, I will give you $1 million with an 8% interest rate. But if the company does well and raises a round of preferred financing, I want the ability to convert that into equity. So I can give up my debt and I can become an equity holder. So it's a pretty flexible method. And it gives you a little bit of priority, right, above the equity holders. But what I'm seeing most commonly, and Steven, I think you're seeing this too, is safe notes. So Y Combinator was an incubator that started in San Francisco, I don't even know, 15, 20 years ago now. And they created this equity form note called a safe note. And a safe note is equity-like. It's not debt. There's no interest rate attached to it. So you don't get priority like you would for a convertible note holder. But what it essentially says is, here, I'm going to give you some money. I believe in your idea. And I also think that someday you're going to have an equity financing. And at that point, I'm going to become an equity holder. And here are the terms at which that conversion is going to happen. So you might ask me, why do people put money in using safes? There's no downside protection. But people really believe that startups are going to succeed, right? And they want a piece of that pie. And they're usually smaller dollar values. So you could put in 25,000, 100,000, $1 million on a safe note, whereas these convertible notes, preferred financings tend to be bigger dollar values.
Well, and I
Um,
think what we've seen certainly is it's the speed at which money is invested. And I think it's from what I understand, a safe is you're not having to put together a whole bunch of legal agreements, a whole bunch of other, stock certificates, figuring out your capitalization table. It's certainly much faster than, say, a bank or another alternative lender that would come in, which you just don't see, a traditional bank investing in these things. A bank wants to have security, it wants to have, something it can attach to, and I think a safe has a lot of that speed, and then it's, as you said, at some point later this can be converted, and I think that valuation, is important. Then, as we talk about people leaving Canada, to say, well, what are these companies worth? And we'll talk a little bit about that in the next session, but that's often what we see is the reason why safes are preferred.
you're absolutely right. They're a form letter, basically. You can make small modifications to them, but companies don't need to invest a lot of money with their corporate attorneys putting together documents. And so, yeah, it's quick and easy, and it's usually smaller dollar values. Although with AI companies these days, I am seeing some bigger kind of valuations on those safe notes than I did in the past. So that's been kind of interesting. And then I will mention qualified small business stock in a little bit. Can we go to the next slide and I can show you kind of the life cycle of a startup? So this graphic here is pulled straight from an article that I wrote. Just put a plug out there that on the Andersen website, there's an article called Founders, How Appraisals Strengthen Your Road to Exit. And what I see is there's lots of, at least in the US, there's lots of reasons why startup founders need valuations. The IRS has lots of appraisal requirements. And so a typical life cycle for a startup would be, you have an idea, you decide, okay, it's a good enough idea to start a company. Many founders start a company as an LLC, as a form of structure rather than a C corporation. And that kind of structuring discussion is beyond the scope of today's discussion. But in the US, at least, people typically start their startups as, or often do, as an LLC. When you do that, then you hire your first employee. In the US, and we'll talk about 409A, Stephen, you mentioned that concept earlier. We'll talk about that a bit later. But 409A is this regime in the US. It's a deferred compensation rule that requires startups to get an appraisal if they're going to issue equity to employees. Essentially, they need to understand what the value is that they're setting that equity price at. For example, if you're issuing options to an employee in the US, you need to understand what that strike price is going to be. And that strike price has to be at or above fair market value. So, you hire your first employee. Now you get trapped in the 409A regimen and you have to get an appraisal. Then as you're moving forward, investors often want to invest in C corporations. They most often, third-party investors do not want to put money into an LLC. And so you would convert to a C corporation. At that point, you kind of unlock this amazing tax benefit in the US called qualified small business stock. And Stephen, you probably know more about the tax implications of this than I do. But essentially, if you hold your stock for a certain period of time, and in the US, it used to be 5 years. Now you can get some benefits as early as
Yeah.
3 years for newer startups. If you hold your stock for at least that period of time, 3 to 5 years, you can get, upon an exit event, you can exclude the greater of, under the current rules, $15 million or 10 times your basis in the stock. And so the basis in the stock needs to be valued at that conversion date. So if you start with an LLC and you move your assets, you contribute your assets into this new C corporation, you need to know the value of your contribution to set your basis, and then also to establish that qualified small business stock QSBS benefit. So this can be huge for companies. I'm doing a lot of QSBS valuation work right now, setting that basis, because in order to really maximize the benefit, your contribution just needs to be worth more than 1.5 million,
Right.
right? If it's worth more than 1.5 million, then you get 10 times whatever that contribution value is. And for some of my startup founders, they might be contributing $30 million of value times 10, and then they can exclude up to 300 million. The numbers get pretty huge. So I'll just finish this off. Basically, as your startup progresses, you raise money from outside investors. Every time you do that, you get a new 409A valuation. And then hopefully one day you get close to an exit event and you start to do some sort of either estate planning where you're putting, some of your shares into a kid's trust, and using up some of your lifetime exemption, or if you're philanthropically minded, you donate some stock ahead of a transaction to a charity and try to maximize that benefit. So lots of reasons in the US that you need an appraisal. Next slide. All right, it's time for our second polling question. Which of the following is not a typical form of equity investment in a startup company? Traditional bank debt, safe notes, preferred financings, or convertible notes?
And as we give our viewers time to answer the question, I think you can kind of see the intersection between valuation concepts and principles and the need for that with departure tax. Because as I said before, when you leave Canada and you cease to be a Canadian resident, you're deemed to dispose of certain assets at their fair market value. And that's, sometimes a very difficult concept to determine on your own. Petra went through a whole bunch of different ways that evaluate things evaluated. It's somewhat straightforward to get a valuation on a piece of real estate because you get comparable sales. It's a lot more difficult to value either, a safe you might have invested in a startup, or maybe you're one of the founders and someone else has invested, depending on the stage you're at. So this is the importance of tying these two concepts together.
Great. Yeah, thanks, Stephen. And it looks like people were listening because I think you answered the question in the middle of the presentation, Stephen. So traditional bank debt is the one that is not common for startups to get because they often don't have a lot of collateral to help securitize that bank debt. And before we move on to your section, I should also mention that when a company gets outside financing, whether it is a safe note, a convertible note, preferred financing, et cetera, or common stock investment, that becomes an indication of value for us that we have to consider. So when you don't have that third-party validation for your company, we can use all these kind of traditional methods to value the business. But once you have a mark, some expectation from an investor, especially in writing, it's something that an appraiser has to take into consideration.
Well, I think that's a great segue into my section there. So next slide, and it talks about timing a departure from Canada, and on that theme, when entrepreneurs are in Canada and they've got startup entities, the longer they stay resident to Canada, and presumably the higher the value will grow as you test out, as you code, as you program, as you get revenue, as you get clients, as you hire people, there's going to be a higher value. And that just is going to mean that there could be a larger capital gain when you depart Canada. So one has to be mindful of that timing when if they're going to make that decision. If it turns out that someone has a capital gain subject to departure tax, there are some ways to handle that tax when you leave Canada. The easy one is just to pay it. The problem with paying it is there's no liquidity in a startup entity, and people are trying to bootstrap. They're trying to put all their money in the company, and so to have to write a six-figure payment to Canada Revenue for a value when you don't have a liquid event for another bunch of years, that's not an easy thing for entrepreneurs to do. So what other things can you do? Well, in a lot of circumstances, you can what's called post security. And so what Canada Revenue allows and Canadian tax allows to basically say, we want to make sure, because you've left Canada, it's going to be difficult for us to pursue and collect that debt. So you've got to post some security with us that says, if and when you ever sell these shares, you will file a tax return. You'll then calculate the tax owing, but we'll have an easier time to collect because you've left something back with us. And so security can take a number of different forms. Security can be the shares themselves, and that could be somewhat limited because to accept security, Canada needs two things. It's got to be a Canadian corporation, and the individual generally has to have controlling voting rights of the shares. There are certain circumstances where a minority interest could work if the other shareholders who have controlling interest would allow it, but that can become cumbersome and awkward and take a lot of time. So if you've got a Canadian corporation and you've got controlling rights, you can just pledge the shares. Canada will take a secured interest in the shares. They'll register that. They will follow up annually to ask you the question if you've sold the shares, because so long as you never sell these shares that are subject to this departure tax, for the length of time you never sell the shares, you're not subject to departure tax until you have an event, until you do something. So it can be an elegant way to time liquidity because 3, 5, 7 years from now, if there is an event and there is hopefully a sizable gain, then you've now got the liquidity to pay the tax, which would happen at that time. The nice thing, if security is posted appropriately and accepted, is there's no interest charge on that departure tax. And so people have time to grow the business and know that there's some Canadian tax to pay, but they don't have to worry about a 7, 8, 10% interest charge so long as the security is in place. Now, for a lot of entrepreneurs that have startups that are USC Corps, there's some advantages there. You wouldn't be able to provide those shares as security. So now you got to look at alternative means to provide security. One of them is just simply what's called automatic security. And that's in situations where the gain's low and the tax is low. And if the tax payable is less than $25,000, so roughly if the gain's around 100,000 Canadian or less, then you can complete a form, sign an undertaking, and Canada will accept your undertaking as security. They'll still follow up and make sure they know when you've sold the shares. That is an option, but it doesn't cover a lot of value because it's only $100,000. Another way would be if you had an interest in Canadian real estate. So if you had a home in Canada, or a condo, a townhome that you hadn't sold, you can put a security interest on that home. Canada will take that charge so long as it's within the ratios of value. They might even sit behind a traditional mortgage as long as there's value over and above the debt that qualifies or captures or covers the tax liability. That could be a way to do that. The other way would be to get a letter of credit or letter of guarantee from a bank. And those are very specific ones that it has to be from a Canadian bank. And also, Canadian banks are not going to just write the letters without assets. And so, use the example if you had a $500,000 value and I don't know, let's say a $150,000 tax liability, that $150,000, if a Canadian bank's going to write a letter of security or a letter of credit on that, that individual would have to put $150,000 in a trading account and an investment account with that bank. It would be effectively frozen. You can earn interest and dividends, but the bank's going to put a freeze on it saying, we'll write a letter on this. We're not taking any risk at all. And we'll charge probably 1.5% to 2% a year on the face value of that letter of credit, letter guarantee. So those are some of the options. Those can be difficult for entrepreneurs that don't have a lot of other assets to post as security. There is something in Canadian law, and Petra and I were talking about this yesterday. I have never had to try and use this, but there is a provision right in Canadian law that says if you can't post security, it's almost like it's written as a grace period to say, well, come talk to us and tell us what your situation is and we'll consider it. So Canada Revenue might consider a situation where you had nothing else, but you had this event. If you couldn't post grace, it might be just talking about your story. And I said, I've never had to go through that. I know the law is there. It would just be interesting to see how one might be able to take advantage of that. So there are some choices here. One of the things might be for certain individuals that have startups that are Canadian corporations, that they can lower the gain if the entity qualifies as something called a qualified small business corporation. Those are Canada's rules that basically state that if it's a Canadian corporation, if it's a Canadian controlled private corporation, if all or substantially all the assets are in Canada, and if you've held the shares longer than 2 years, there's about 6 or 7 requirements you have to meet. Then on a deemed departure, there'd be a sale, and the first 1.25 million in your lifetime of gains could be tax free in Canada. So that's another way to try and minimize that tax on departure. It's got to be very specific that you got to meet these tests. But one of the big ones is it's got to be a Canadian corporation. And as Petra talked about before, and we'll get into this a little bit, there's a lot more tax advantages to having a US C corporation as your entity versus a Canadian corporation, particularly if you're moving from Canada to the United States. And so that's not often something the right answer for people. And as I said, 1.25 million Canadian is nice. It's a fraction of the 15 million US that you get for qualified small business stock. And it's even a smaller fraction if you can multiply by 10 times basis in Petra's example of 30 million times 10 or a $300 million, sizable gain. So it's there. It may not be the right answer for people. There may be some other options as you depart Canada. There's choices here, and best thing I can always say to people is make sure you get proper Canadian U.S. tax advice. Something I work with clients often before you leave Canada or before you make these decisions. Next slide. So as you go to the United States, there are some common US tax implications when you move from Canada to the United States that can affect technology entrepreneurs. One of those choices would be to take advantage of a provision under the Canada-US Income Tax Convention that effectively says if you've got a departure tax on an asset and you're paying Canadian tax on that asset, then it would be unfair for federal tax purposes if you didn't get an increase in your cost basis of that fair market value, and 3 or 5 years later you sold the stock and you paid tax again at full US federal tax rates. And so 20 years ago, both countries negotiated a provision in the Canada-US tax treaty that basically says if you're a Canadian, if you're moving from Canada to the United States, and if you've got this departure tax, you get this deemed disposition, you can make an election under the treaty for US federal income tax purposes to effectively have this deemed disposition of that asset and a reacquisition at fair market value. And so the advantage is that you reset the cost basis of your shares, of your investment, of your assets to their fair market value, so that for federal tax purposes in the US, only post-move gains would be taxable. Something we see often, something that makes a lot of sense. It would be great if all of the states followed that election. And Petra smiles because she's living in one of those states. California, for 30 plus years or more, has always said we did not sign the Canada-US income tax treaty. That was signed with the federal government. Unlike Canada, where the provinces and the federal government work together for the most part on tax law, California is very different. California follows its own rules. It's got its own tax legislation. In particular, it does not follow the Canada-US income tax treaty. So your cost basis for California state tax purposes generally is whatever the original basis is. And there may be some strategies as you move to California that you can conduct ahead of time to recognize something in Canada to increase the basis. There's some case law in California that can help you there. It's just something you got to be aware of, that California tax rates are high. A lot of people are going to San Francisco, they're going to Silicon Valley, and they just need to be aware that California is not going to follow that treaty rule. We talked a bit about the qualified small business stock rules. I won't repeat that, other than it's a really generous benefit, and it's improved since the One Big Beautiful Bill Act last year. That's increased the dollars. It's lowered the time from 5 to 3 years. You don't get a full exemption on 3 years, but it gives you something. It's a federal tax law. California doesn't observe the qualified small business stock rules, so you might have a situation where you're not paying federal tax, but you're paying state tax. We'll talk a bit about a strategy on that. My understanding is New York State is also trying to uncouple the legislation so that New York State may not follow qualified small business stock rules as well. It's locally here, Washington State has a capital gains tax and has had it for a few years now. So you get these different rules between federal and state law. One of the things that entrepreneurs face is what's called an 83B election, and that's a U.S. election that basically takes the awards of the stock that you receive and gives you a choice that says, if you want to have this as capital property as opposed to employment income, you can make a choice and you can make a final election that says, I receive some capital property. It may not have vested with me. It may still have some restrictions, but I want to treat that as capital property to me. And I want to do it from the moment I get it. And why would you do that? Well, it becomes US income tax rates is the reason you generally do it. Because if you receive something as an employee of a company and it's considered employment income, then your income tax rates in the US go to the top marginal tax rate, which is 37% right now. In contrast, if you hold a capital asset and you hold it for longer than a year, then you can get something called long-term capital gains tax treatment, and the rates can be less than half that 37 per rate. The federal rate is 20%. There may be some Obamacare, the net investment income tax, but your tax rates are a lot less. What the 83B election does is it allows the investor to make an election to say, I want to treat that capital asset. I want to treat those shares I got, even though there may be some vesting concerns, or maybe I don't really have them all. I can treat them as being received so that I can start treating it as a capital asset. Usually you want to do that when the valuation's low, because part of the 83B election is you're treating it as employment income. And why you make the election is if it's worth 10 cents or 2 cents, you don't care if it's a couple of dollars worth of employment income taxed at 37%. You really want the post-election appreciation tax as capital gains rates. 83B elections need to be filed timely. There's no extension on them. Usually it's 30 days from the date you sign and receive the award of the stock, and there's no late elections filed. So this is something that's critical, and you need to make this election. And Canadian entrepreneurs can file this election if they're moving to the United States. They don't necessarily have to be a U.S. resident to file this election. They don't have to be a U.S. citizen. They can file that election to treat that if there's any doubt. So I recognize we're getting close to time here. We'll come back to Social Security taxes in a minute here if we have some time. I think we've got another question. So our third question today is going on security. And if you cease Canadian residency and you want to post security, here's a list of 4 things that Canada Revenue that people could post, and the question is, which one of these 4 would Canada Revenue accept as security to secure the debt against departure tax?
Even while we're waiting for answers, I just want to jump in on the fact that states don't always conform to federal in the U.S. It's so complicated. In California, we actually see a lot of folks, it's been in the news, I'm sure in Canada as well, folks, especially billionaires, trying to leave California to other states to avoid things like the potential billionaires tax and things like that. But the franchise tax board in California is notoriously difficult. And they will hunt you down. And so if you are planning on leaving California, you have to be very careful and follow lots of different steps to make sure that you really have completely left and are not still seeing your veterinarian in California and things like that, because they will find you. We have had those stories here. But anyway, yeah, so it is funny in the US how the states don't conform to federal that way.
Well, that's a great segue. One of our colleagues, Eric Andersen, who's a state and local tax managing director in San Francisco, and Petra knows Eric well. He was on our webinar about a year or 2 years ago. We talked about that very subject and some of the work they do with entrepreneurs that are much later in the cycle and they got an exit and they look around and say, well, I don't need to live in California anymore. I could live somewhere else. And as Petra just said, it isn't just, getting a 1-bedroom condo in Henderson, Nevada. Like, you need to move and you need to make it legitimate, and you have to change your domicile, and there's steps you need to take. And Eric had a great example of that. So that's one of our past webinars. So the answer to the question is supposed to be letter of credit or guarantee from a Canadian bank. That's really everything. That's really the only one of those 4 that Canada Revenue would easily accept. There are limited circumstances where shares of a Canadian corporation where you have a minority interest could be pledged, but it's complicated. It's going to require, sign off from the voting shareholders, the controlling shareholders. They may not want to do that because it's going to restrict them as well. So I'd encourage people to say, well, unless it's a letter of credit guarantee, we'd want to explore some of those other items. So, Petra, I'm going to turn it back to you.
Thanks so much, Stephen. So we don't need to spend a lot of time on this topic, but I want to introduce it because 409A is just every startup founder in the US knows what 409A is or has heard it. And so it's important for you if you're a founder thinking of going to the US that you understand this concept too. So I mentioned earlier that under Internal Revenue Code Section 409A, it covers deferred compensation. And what the IRS is essentially trying to do is say, if you're issuing equity to employees, you have to be issuing it, you can't be issuing cheap stock. So it needs to be at or above fair market value. And fair market value in the US is almost the same definition as in Canada. So the basic concept is it's hypothetical buyer and seller who have full information, are doing a negotiation, there's no duress. And it's essentially a financial buyer concept. So if you're really just negotiating on the merits of that investment, what price are you going to come to? And so a company who is issuing equity options or RSUs to an employee needs to make sure that they are getting an appraisal at least every 12 months. So if you want to fall under the safe harbor rules of IRC 409A, then you need to get an appraisal at least every 12 months if you are issuing equity or if your employees are vesting or exercising their equity. There's certain triggering events that require an updated appraisal. So if you just continue to be self-funded, you really can usually just go every 12 months on that cadence. But if you have an outside round of financing, that's a trigger for a new valuation. Or if you have a substantial acquisition, or there's some huge milestone in your company, if you're let's say a biotech, and you get, a clinical approval or something like that, that would be a big milestone in your company's life. And so you would need to get a new appraisal at that point. If you don't, the penalty is actually for the employee. So if the employee's tax return at some point gets audited and the IRS determines that exercise price, for example, was below fair market value, let's say that the company was not in compliance with 409A, then the employee is subject to penalties and interest. So I think it's a 20% additional tax plus interest. And so it's a pretty onerous penalty, and most companies don't want their employees to potentially be liable for this. The company also might be liable for some payroll tax penalties as well. And so this concept of 409A first started in 2004. It was really codified in 2006. And since then, it's just become the standard. So startups always get 409A valuations. Now, some corporate counsel might say, maybe you can get away with not doing it in the very earliest stages before you have some outside rounds of financing. But by the time you start getting outside money, you should definitely be doing this for good housekeeping. And I kind of consider it an insurance policy, essentially. You get that valuation report, now you have it in hand, and in case the IRS comes knocking, you're ready. I will say that you can companies want to use 409A appraisals for all different purposes. For deemed disposition, Stephen, a 409A appraisal is probably a pretty good indication of value for that purpose. Is that right?
I think any indicators of value would be considered both for the taxpayer determining valuation, and if it was ever under examination, CRA determining that. And so anything from a 409A valuation to initial investments, second round investments. Some of the methodologies you talked about, whether it's discounted cash flow, if that's even possible, or cost basis or hours based. I mean, any one of those things can be considered. And I think the important thing is it's all the information considered. It's what happened, after you left. It's probably more important what happened before you left Canada. But if it's the day after you left Canada, I think that information is important too. If it's 3 years after you left Canada, maybe not. These are concepts that are really important for taxpayers to understand that fair market valuation is something you talk about with your investors and your team, and you're excited about it because it's going to have something that's going to be great, very valuable. But at the same time, when you're thinking about tax law, you have sometimes a different answer as to what the real value is, and you can have a kind of inherent contradiction between what you really think the business is versus what you want it to be worth. And you've got to reconcile those two. You can't, one should not just kind of make up numbers saying, oh, it's not worth anything, but I think it's worth 10 or $20 million. That's the importance of having a proper valuation done uh, as proof of what that gain, if any, is going to be when you leave Canada.
I'm happy you brought up that last point because so there are different standards of value in the appraisal arena, and fair market value is one standard. And like I mentioned, that's more of kind of a financial buyer, sort of negotiating on the merits of the economics. If you are trying to get outside financing and you're talking to investors, right, you're hyping up all of the potential positives of your company as opposed to the risks. And so you might be under an investment value, standard of value. So those two values can be different. Investment
Mhm.
value, because there can be synergies or future, I don't know, benefits. There's lower risk kind of baked into that investment value thesis rather than this fair market value thesis, which kind of balances the risk and the reward of startups. So I'm happy that you brought that up. I will also say that in the US, so fair market value is the standard of value that's used for all IRS related appraisals, but a 409A appraisal specifically is addressed to the company and it concludes the value of one common share. Now, if you, as an individual founder, are doing something like making a gift to a trust by transferring shares to a trust, or donating some shares of your company to a third party, to a nonprofit, then you actually need a different appraisal, which is also fair market value, but is concluding the value of exactly what you're gifting, like the number of shares that you're gifting on the date that you made that gift, and the valuation is addressed to you. So the answers could be similar, but they're different appraisals. So I just wanted
Yeah.
to point that out because people think 409A can be used for everything, and technically no. So
Right. Okay.
yeah.
Excellent. Excellent.
All right.
Well,
Next
well,
slide. I think we're almost out of time.
hey, this is great. So we've got time for a couple questions as we kind of get to the top of the hour here. One of the questions just on our Q&A here, it reads, and I'll answer this one. What if your Canadian corporation holds Canadian real property? Canadian real property is not subject to exit tax, but the shares of the company are. How does that work? And I think it's a really important distinction. One I tried to make as best as I could is the direct interest in Canadian real estate, direct meaning you're on title individually, that would generally not be subject to departure tax because there's other ways to tax it. However, that same property, if it's held by a Canadian corporation and you own the shares of that Canadian corporation, that is subject to departure tax in Canada. And even though it's the same asset, it's the form of the ownership. Those shares are subject to Canadian departure tax, and so you'd go through the same procedure. You'd have to value that company. You'd have to value the shares. You'd have to post security or pay the tax. It can be a little easier if you owned 100% of the shares and it's real estate because you can get it appraised to pledge those shares to security. But there is a real distinction that's important there. So that was one of the questions. Petra, there's a question for you, and we talked a bit about valuation and some of the different standards. How often do you see it challenged by the Internal Revenue Service?
It depends on what type of valuation we're talking about. So 409A rarely gets challenged. So the IRS, many years ago now, maybe 15 years ago, they hired a bunch of people to try to train them to be, 409A reviewers. But 409A involves option pricing models and kind of more complicated capital structures. So it's really different than all the other types of appraisals that the IRS is used to reviewing. And it kind of just never gained traction. And so I've heard through the grapevine of maybe 3 or 4 audits on 409As. I'm sure that there's been more, but we're talking about 20 years. So it's not a heavily audited area. But charitable donations, if you're donating shares to a charity, that gets audited all the time. Like
Mhm.
literally every single time you make a substantial donation, you're going to get audited. Maybe I shouldn't say literally, but it is a very commonly audited appraisal. And then if you're making a gift, that is sometimes audited. It's not uncommon to see an audit on that, but it's not something that's an immediate audit the way that a charitable donation is.
Excellent, excellent. One other question we had before we started. It's with respect to Canadian-controlled private corporations. So that's a very specific Canadian tax term. It refers to private corporations formed in Canada that are controlled by Canadian residents. And in our context here, these are individuals that are leaving Canada, potentially moving to the United States. And so what happens to that Canadian-controlled private company? Well, a couple things. One, in my example, let's say the 100% owner uh, no longer resides in Canada and they move to the United States. Well, that corporation loses its status as a Canadian controlled private corporation because the controller, the owner, the one who has more than 50% of the voting or de facto de jure control of the company, they no longer are a resident of Canada. So it's no longer Canadian controlled. So a couple things happen. One, the small business tax rate, if the company was profitable and was paying income tax at some of the low rates here in Canada, the first $500,000 is taxed at a fairly low rate, that disappears. So now profits are taxed at 27%, 25%, depending on the province. So the tax rate's higher. But more importantly, for a lot of these startups that have a program where they're doing scientific research and development expenditures, or SHRED as it's commonly known. The nice thing in Canada is that can be a refundable payment from the government to the company if they're losing money. That's only if it's a Canadian, generally only if it's a Canadian controlled private corporation. If it loses its status, now that refundable money that comes every year sits as a credit against future taxes. And so where the Canadian government has a fairly generous program that finances a lot of the scientific research and exploratory expenditure development programs, that's no longer refundable. It just sits as a credit, and so it may not be of as much use. There are programs in the United States that can mimic this depending on the structure you set up. It's kind of beyond the expertise and scope of us here. There are also some other incentives under U.S. law that allows you to expense things that you could had to amortize before. It These are all the different factors one has to take into account when they're trying to make that decision whether to relocate to the U.S. or not. So. I think those are the questions we had we want to answer. I want to thank everyone for their time here. We've got a little disclaimer there. We've got a slide right at the end in terms of just a summary. If you've got questions and if you want to follow up with us, please do. You can email us as you signed up and we'll try and answer them as best we can. If you would be so kind, please take the survey to help us improve. Give us some ideas for topics you'd like to see in the future. And I want to thank everyone for attending. Really appreciate everyone's time today. And thank you, Petra, for joining us. Great to have you on today.
Of course, that was fun. Thanks, Stephen.
Excellent. Thank you all.